webinar series, Visualize Your Success in 2020. My name is Yvonne Pelkey, and I will be your moderator for today's webinar. You know, it's always been the mission of GPN Technologies to provide the best business tools and resources to help eye care professionals achieve their goals and find success. And that's the premise in which these webinars were created. It was to connect you with industry leaders who are so excited to share their knowledge and their experiences in overcoming these challenges that face us on a day-to-day basis. So before I introduce to you our featured speaker, I just have a few things that I need to go over. One, our session is being recorded, and so to help reduce the background noise, we have you in listen-only mode. But we do love questions and encourage you to utilize the chat feature within Zoom. At the conclusion of our webinar, the recording will be available to you by the end of this week, and you will receive an email with the link to the recording. So everyone in attendance today will receive that link. Also, if you're a current Edge Pro user, you can find the link within the Need Help section within Edge Pro. Speaking of Edge Pro, we want to help you achieve your goals and find success. So take a look in the chat feature, look for a link for a free 90-day trial of Edge Pro. And finally, at the conclusion of our webinar today, we'll be sending you an email with a link to complete our survey. Please take a moment to do so. Your feedback is incredibly valuable for the continued success of our future webinars. Today is the first of our year-end webinar series, and our topic is The Profitable Doctor, Eradicating Practice Poverty. So before we get started, I'm going to tell you just a little bit about what we're going to be listening to today. So Dr. Kling, who's our featured speaker, is going to be talking about the #1 financial challenge that most optometric practice owners face today, and that's poor cash flow. He's found that doctors owners often fall prey to focusing too much on top-line revenue growth while ignoring the increasing expenses and debt that accompany growth. And we know that without a plan, we can find ourselves living insurance check to insurance check, wondering how these business owners are going to make payroll, financially overwhelmed, and completely stressed out. This course is going to present a revolutionary new cash flow management system designed to immediately improve practice profitability, eradicate those unnecessary business expenses, and assist practice owners with managing their business debt. And on that note, I am very excited, and it's my absolute pleasure to introduce our featured speaker, Dr. Mick Kling. Dr. Kling, please take a moment to introduce a little bit about yourself.
Hi, Yvonne. Thank you so much for having me. It's just such a privilege and an honor to be able to kick this fall series off, and for me to be able to take a little bit of time and share some of the things that I'm really excited and passionate about is really a big privilege. So thank you to you and your team. My name is Mick Kling. I'm an optometrist in San Diego. I have a single location practice. I've got 3 associate doctors. We practice out of one large location, and I have the privilege of seeing patients 1 or 2 days a week. And the rest of my time I spend as a business coach. I work for Vision Source as a business coach for Vision Source practices. I also have a consulting business on the side, and in my consulting business, I work with doctors one-on-one. And the primary question that I get asked all the time is, where is all the money? That seems to be the main question that I get. I'll get phone calls that say, Mick, I've got $1 million practice, but there's never any money to pay the bills. I can never seem to make ends meet. I struggle with payroll. I'm worried that the VSP check is going to be big enough. And so that's a very common scenario that most practice owners face. And so what I've done is sort of taken my own experience over the last 25 years of running my own practice, and the fact that I just love the numbers and spreadsheets and studying how businesses operate. And I've taken that and created a model that I first implemented in my own practice, and then realized that this is something that I can share with others. And so that's what I do in my consulting business. as I share the systems that I use in my own practice for other doctors, and hopefully allow them the opportunity to gain some new strategies and some new skill sets about how to manage the cash flow in their own practices.
That's awesome.
Well, listen, Yvonne, again, thank you guys so much for having me. And I'm going to go ahead and just get right into this. One of the things that I find when I'm out and about speaking is that if we are to believe what happens on social media, everybody in the world is doing great. Everybody's personal life is fantastic. We all have the giant houses and the fancy cars and the pool in the backyard, and our kids all go to private school. And that's the lie that we seem to hear all the time through this avenue of social media. That also translates a lot into our businesses as well. And I find that a lot of doctors are very uncomfortable having conversations about what's really happening in their practices when it comes to the business finances. And in fact, when you really peel back all the layers and become very honest about what's going on within the practice, almost every practice struggles financially to some degree. And according to the SBA, only about 40% of all businesses survive beyond 6 years. But what never gets talked about is the 40% of the businesses that do survive, and how few of those businesses are actually profitable, and how much they struggle to make ends meet, often starving their businesses of cash flow because they're maybe pulling too much out of their own practice, or just not managing the business properly. And so the reality is a lot of businesses are struggling way more than we would like to admit, because it's a little bit taboo to talk about money. When I was a kid, my mom always told me, whatever you do, don't ask what somebody makes. But now in my current job, I ask every day how much money you make. And I'm finding that when we can get to that position of real true honesty about what's going on with our business, a lot of businesses are struggling. And in fact, if you look at what's really happening in America, the personal finance guru Dave Ramsey says that about 80% of us are living paycheck to paycheck, and only 20% of the financial crisis that a lot of us face really only come from those that are in poverty, which means that having financial struggles and stresses in your life is not a poor person's problem. This is a problem that everybody faces along every aspect of their life, no matter where you are financially. And it's because we learn to grow into our new set of circumstances, and we learn to grow into our new financial situations. About two-thirds of us carry some credit card debt, and NerdWallet says that credit card debt's somewhere around $16,000. We have about $28,000 in card debt, and the average student loan debt's somewhere around $47,000. In fact, I recently read that student loan debt is now starting to surpass mortgage debt, especially within the millennials, as the leading source of debt for an American. And as the millennial crowd gets, the population of millennials gets larger and larger, that problem is going to continue to carry forward. And so this is a real financial crisis for our country. And a lot of times this happens because we don't have a plan. And what I'm going to present today is some structure and a plan that I've implemented in my own practice of some of the ways that we can address this, so we don't find ourselves as another average American who has all these kinds of financial problems. If we look at what's happening within our practices, there's something that happens very commonly called a cash flow pinch. And the blue line on this graph that you're looking at now is the income of a typical practice, and the orange line are the expenses. And one of the things that happens as we grow our business is that as our income of our business increases, our expenses trail right along with it. In other words, as the business grows, we might need to invest in a larger piece of real estate, or we might need to hire more employees, or our cost of goods might go up. But as the revenue goes up in the practice, our expenses trail right along with us. And what often happens in a business is that when that growth occurs, if at some point the revenue starts to decline, our expenses don't just magically stop. In fact, they continue to grow. And then there's a crossover where expenses start to exceed our income, and we get these cash flow pinches. And this happens over and over again. And I think the problem that most of us face in our practice is that we're too much focused on top line revenue growth. If I could just get to $1 million practice, everything's going to be fine. If I could just get to 2 million, everything's going to be fine. But what we're not doing is we're not baking in profit into our businesses first and getting that piece of it taken care of. And then as the business grows on the top line revenue, then that profit grows right along with it. And so our focus needs to go from not how do I make $1 million practice or 2 million or a $5 million practice, but how do I take what I've got existing and make that as profitable as I can. And so what I'm going to present to you is an entirely different way to look at profitability. And most of us, when we think of the word profit, we think about a business that actually has money left over after we've paid all the expenses. And in the accounting world, profitability is simply an accounting term used to calculate what our tax bill is going to be. And we often find that number based on a report in our business finance software called our profit and loss statement. And a lot of us will look at our profit and loss statement and see a black number, which is a number that's in the positive, and think, yeah, we're a profitable business. But what we're not understanding is that the profit and loss statement does not explain to us what's happening from a cash flow standpoint. And it's because we're not understanding what profit means. And so what I'm going to present to you is a concept that comes from a book by a business writer named Mike Michalowicz. And the name of the book is called Profit First. And I'm going to walk you through the philosophy that this book presents as a way to now run your business. And at the core of this concept is the idea that profitability in our business is not something that we wish for or a desire, it's actually a decision. It's a decision that we make within our business. It's not a result, but it's actually an action that we can take. In other words, there are things that we can do within our business to absolutely guarantee profitability no matter what's happening with the top line. And it's not an event, but it's a habit. In other words, we can create a rhythm to make sure that no matter what's happening outside in the economy or outside in the world, our businesses are always profitable because it's a habit that we've created within the business. And so in a nutshell, profitability becomes a choice. We have the ability with this system to actually just choose to be profitable. So that's what we're going to go through today. Now, one of the first things that I want you to think about is think for a minute how much money you have in your business bank account right now, because I know every one of you guys at some point probably has picked up your cell phone and checked your business bank account balance. And that's called bank balance accounting. And we all do it because technology has allowed us the ability to use a small device to really take a look very quickly at what's happening with our business finances. The problem with bank balance accounting is it doesn't really explain to us what's really happening in our business. Because when we pick up our phone and we check our bank balance, we might see a big number or we might see a small number. If it's a big number, we make some sort of assumption about how our business is doing. We might look at a big number with lots of zeros and think, for instance, that we're doing great. I'm a great businessman. I know what I'm doing because my bank account has a lot of money in it. Or we might look at our bank balance and see a small balance, and it might make us feel like we're a failure or we're not running the business properly. And we're letting the balance in our bank account actually provide some sort of business insight, which is somewhat misleading because it doesn't really tell us really what's truly happening with our practices. In fact, if you ask your CPA, hey, would you recommend that I just run my business off of my bank balance? They would tell you absolutely not. You need to be looking at your profit and loss statement. You need to be looking at your balance sheet, your statement of cash flows. We need to be budgeting. Well, none of us do that routinely. We instead look at our bank balance. And so what this system does is it allows us to use our natural tendencies to actually look at our bank balance and provide us with a much clearer, truer picture of what's happening in our businesses. Now, if you remember back in 8th grade economics class, you might remember something called GAAP. And GAAP stands for Generally Accepted Accounting Principles. And this is the government's recommendation that the way all businesses manage their business finances. And in its most simplistic form, the formula for GAAP says that sales minus expenses equals profit. And basically what that means is that we sell things in our business. We sell services, eye exams, glasses, contact lenses. We have some expenses that are incurred relative to us delivering the sales. And what's left is profitability. That's a traditional formula for GAAP. What Profit First says is that we're going to reverse engineer the equation. And we're going to instead say that sales minus profit equals expenses. Now, mathematically, it's the exact same formula. We've just reversed the order in which things have come. We've made profitability the most important thing before expenses to make sure that we're locking in, we're baking in profitability in our business, and then we're paying our expenses after we've taken our profit first and learning to live with what's left. And if this seems like an unusual concept, it's extremely common. Think about if you earn a W-2 paycheck and you earn $1,000 worth of income, you don't get to take home $1,000. What comes out of the $1,000 paycheck is maybe some taxes or possibly some health insurance or maybe some retirement account, a 401k investment. And what happens is you're left with a net check and you learn to live with what's on left. And so human behavior dictates that when we take out certain expenses first, it will force us to change our behavior and live on what's left. And that's essentially what we do with the profit first concept in our business, which is we take the profitability out first, and then we learn to run our business on what's left. Now, there are 4 core principles to this profit first concept, and my job over the next 20 or 25 minutes is to convince you from a human behavior standpoint why this system works. And so I'm going to walk through these 4 core principles with you very quickly and try to convince you that this is going to work. Now, I've presented Profit First to thousands of ODs by now, and I will tell you that about 10% of you guys that are listening to the webinar are going to think this is absolutely insane, absolutely crazy. It will never work for me. It's too complicated. I just will never do it. 10% of you, this will forever change your practice in your life like it did me, and it will revolutionize the way that you run your business. And about 80% of you will listen to this politely, but you will go back and you will do nothing different. And that's just human nature. And so for those of you that will do nothing and don't believe this will work for you, or the 80% that just go back and absorb it without taking action, let me just remind you that if you want something to be different, you have to do something different. And there's something in psychology called confirmation bias, which basically says that we tend to put more value on evidence that reinforces what we already believe. And so what I'm going to suggest to you is that you put your confirmation bias to the side for just a few minutes as I walk through this and give this a chance to work, because the practices that I've worked with, it has been an absolute game changer. So let's go ahead and walk through these 4 concepts. So the very first concept, and the example that's given in the book, is called Parkinson's Law. And the analogy that's given is if we were to hire a weight loss coach to help us lose weight, one of the first things that a weight loss coach would tell us is to eat off of smaller plates. And the reason is Parkinson's Law says that the demand for something is directly related to its availability, meaning the more that's available, the more we will consume it. So if there's more money available in our business bank account, we will have a tendency to consume more of it. So if we learn to live on a smaller plate, we will in fact consume less. And in California, which is where I live, in San Diego, it's very common for them to add another HOV lane, a carpool lane, and this is what happens. It just fills right back up. And a great analogy they give in the book is about toothpaste. And think about when you get that brand new tube of toothpaste and it's nice and fat and juicy, and you squeeze that bead on your toothbrush and you brush away, enjoy that big nice glob of toothpaste. Well, what happens if that toothpaste falls into the sink? Well, we tend to just wash it down and put another big fat bead on there. But when our toothpaste gets very small and used up, and it's like you see on the screen, two things happen. One, we become very frugal, and two, we become very innovative. It forces us to learn to live on what's left, and we are much more careful about what how we're using what's available to in the form of resources. And that's what happens with money. When we have less of it available, our human behavior changes and we learn to live on less. So that's number one, Parkinson's law. Number two is we want to serve sequentially. And there's something called the primacy effect. And basically what the primacy effect says is that when things come in an order, we place greater value on things that come first. So for instance, if we go to the grocery store and realize we forgot our grocery list, we'll often remember what's the first, second, and third thing on the grocery list, but we'll forget what comes after that, because the way our brains are made, things that come first in order, we place greater emphasis on and greater value. So when we put profitability before expenses, now suddenly profitability becomes more important. So that's core principle number two, called the primacy effect. Number three, back to the analogy of losing weight. If we cannot control our temptation to eat cookies, obviously the most beneficial way to avoid that is we just don't buy cookies. And so simply removing temptation goes a long way in making sure that we're meeting our goals in this example of weight loss by simply just not even putting in the realm of possibility that we'd be tempted to do that. So when we do that with our business finances, it changes behavior to the point we can learn to put money aside, not be tempted to tap into it, but yet still achieve the goals. So that's the third core principle, which is we want to remove temptation, and we do that by hiding some accounts. And the fourth and final is systematic transfers. We want to create a rhythm. You know, our bodies were made for rhythm. We like the beat of sound. And when we get our businesses into a financial rhythm, it takes us a long way to meeting our goals of getting our financial house in order. And so we want to structure the way we pay our bills and the way we move money within our business in a rhythmic way, because once we do that, we'll start to really get a great handle on what's happening with the business finances. So those are the four core principles. We want to eat off of small plates. We want to serve sequentially. We want to remove temptation, and we want to create a rhythm. Now, this is where I'm going to officially lose 10% of you, but I want you to hold on. So remember I talked about bank balance accounting and how sometimes our bank balance is big and sometimes it's small. Well, that happens because most of us operate our businesses out of one business account. All of the income comes in to the account and all the expenses come out of that same account. And so that account will expand and contract based on the availability of cash flow. And it's giving us some indication of what's happening with our practice, but it's really deceiving us and not telling us really what's happening. And the way we overcome that is we set up 4 additional free checking accounts that we link to our main operating account. So now we run our business off of 5 business bank accounts. No longer do we run it off of 1, but we run it off of 5 total. The account that used to be our main operating account, we now call our income account, and we only deposit income into that account. From now on, we no longer pay any bills out of that account. With the 4 additional accounts that we have linked to that income account, we call one of those profit, we call one of them owner's compensation, we call one of them tax, and we call the other one operating expenses, or what we call OpEx. And the purpose of these 4 additional accounts is that we are going to move at a very particular time of the month a certain percentage to each of these 4 different accounts to make sure all of those 4 needs are met. I think we would all agree that our businesses have got to be profitable to sustain themselves. And so what we're going to do is we're going to make sure that we first move a percentage of every dollar that comes into the business into our profit account. We're now going to move a percentage into our owner's compensation account, and that's money to pay ourselves. We're going to move a portion into the tax account because we've got to pay Uncle Sam and make sure we have appropriate tax reserves set aside. And then and only then, with what's left, do we move to our operating expense account. And out of that operating expense account, we now pay our bills. And so what that does is that forces us to run our business off of a smaller operating expense account, because we've allocated money to profit, owner's compensation, and taxes before we've moved money into our operating expense account to run our business. And so I imagine what some of you guys might be thinking is, well, what happens if there's not enough money in the operating expense account when it comes time to pay the bills? Well, that's going to be your very first indication that you're not running your business properly. If you have a stack of bills that are piled up and it's time to pay those bills, and you look in your operating expense account and you don't have enough money to pay those bills, you are not running your business properly, because we have to be profitable. Everybody would agree. We have to pay ourselves. We're the most important employee in the business. We have to make sure that we get a return on investment in our business. We have to make sure that Uncle Sam gets his fair shake. And then and only then do we learn to run the business on what's left. So that is the core of how we set up these 5 accounts.
Dr.
Yes.
Kling. So sorry. We've got several questions that are coming through on your last slide there. So when you talk about your income buckets and then, you know, funneling that over into 4 other buckets, so to speak, is it a percentage or an average? And then, like, how many times are we doing this, you know, per month? Is it like every time we deposit money into a bank, or is it
two great questions, and I'll get to one of those in just a second, which is the when do we do it, but I'll just tell you on the surface, we allocate a percentage of every dollar into each of those buckets or these additional bank accounts. And the very first thing that we do when we analyze a practice is we do something called an instant assessment. And we want to know historically, what have you been applying to each of those segments of your business. Most businesses have not deliberately taken a profit, so that's 0%. We calculate what the owner's compensation has been historically. We calculate what the tax liability has been historically. And what we do is we slowly increase the percentage by 1 percentage point every quarter, simultaneously decreasing the operating expense by 3 percentage points, so that we always total 100%. Okay, so as an example, let's say we start off that historically we've had 0 profitability in the business. Quarter 1, our goal would be to transfer a mere 1% into our profit account for the entire quarter. At the end of quarter 1, we're going to increase our profit allocation up to 2%. We're going to increase our owner's compensation up 1 additional percent, our tax account up 1 additional percent, simultaneously decreasing our operating expense account. Because the idea here is to squeeze our operating expenses as tight as we can, so that we're making sure we're moving more money into those 3 other buckets. I will get to the when do we do it question in just a second. So that's another good one. Okay, so here's what it looks like.
Oh,
yep, go ahead.
I have one more question. It's about the taxes. So we're funneling money over into the tax bucket. Are we talking about sales or provider taxes or both? And then the second part to the question is, like, how do we handle, you know, a practice that might be an S corporation and those taxes are being passed through to the owner?
Great. 2 great questions. So what's the purpose of the tax account? The tax account is intended to be a reserve account, so that you're making sure a portion of your income is set aside to make sure that your quarterly tax estimates are covered, and also make sure that you have reserves for the year-end, what I call the year-end CPA surprise. You know how at the end of the year they give you the big surprise, hey doc, great news, you're profitable, by the way, I need a check for $25,000. You pull up your phone and you're like, there's no money. How can that be? And it's because we're using a lot of times next year's cash flow to pay for last year's tax liability. We want to stop that. We want to make sure that we're allocating money to pay our quarterly tax reserves, and also make sure that we have the year-end tax surprise covered, and really any other taxes that your business has to pay on the owner's behalf should be included in that, including, and here's the great news, once we get our tax percentage up to the appropriate level, the idea is that if you are taking a W-2 wage out of your, being compensated as if you have an S corporation and your W-2 compensated, the tax account should also serve to reimburse you for the taxes that are taken out of your W-2 pay. It's your business. Shouldn't your business pay for your taxes for you? My feeling is yes. So as we build that tax account and get it bigger and bigger and increase the percent allocation, that money is meant to reimburse, cover all the business taxes and reimburse us on the W-2 side. The second question was, what if I'm an S corporation and I have a W-2 wage and I'm also take a distribution or a draw? The owner's comp account is intended to cover both of those. When it's time to do payroll, if you're being paid through payroll just like your other employees, you'll need to move the portion that's a W-2 wage from the owner's comp account and fund the operating expense account to make sure that that portion is covered. If you don't do that, you'll be double dipping, meaning that you'll be paying yourself a W-2 wage out of OPEX, but you'll also be pulling money out of the owner's comp account. So we need to make sure the owner's comp account reimburses OPEX to make sure that our W-2 wage is covered. Hopefully that got it. So here's what the 5 core accounts look like. All the income comes in here. And then we make these allocations to each of the 4 different accounts based on our allocation percentages and the timing of when to do it. Now, I told you guys a little bit of a story, told you a little bit of a lie. I said we create 5 accounts. What I really meant was 7 accounts. And here's the reason we do 7. We want to set up 2 additional savings accounts at a completely separate banking institution. And the purpose of these 2 accounts is that we want to use these as hold accounts because we want to be able to hold some profit and we want to hold the tax reserve so that it's there and waiting for us when we're ready to access it. We want to be able to pick up our phone and not see that money at all, because in our primary bank account, that money needs to disappear because the goal here is to remove temptation. And make that second bank as difficult to deal with as possible, meaning make it very difficult on yourself to get that money out of there. We want to make sure, like the analogy of cookies, we make it very hard to get to the cookies when we don't buy them. So the point of the 2 no temptation accounts is to make sure that we set aside the reserves. Now, I'll tell you guys, having done this for a while, banks do not like to play nice. You can transfer money between bank accounts, but there's usually a 2 or 3 day delay. So just be prepared for some of that delay that occurs. It may be a little bit of difficulty, but the point is get that money out of sight, out of mind, so that you're not tempted to access it. Okay, so when do we do it? Well, I mentioned that we want to create a rhythm, and the best practices on creating a rhythm is that we're going to now pay our bills twice a month, and we pay our bills on the 10th and the 25th of each month. And we do that because there are some bills that are typically due in the middle of the month, somewhere around the 15th, and there's some bills that are due somewhere around the 1st of the month, and we want to make sure those are covered. And so we now pay our bills only on the 10th and only on the 25th to meet those needs. And so that's when those allocations are made. So there's the 10th and there's the 25th. Now you'll see the 2 additional X's on the 3rd and the 18th. In my practice, we pay payroll on the 5th of the month and on the 20th of the month. Somewhere around the 3rd and the 18th of the month, there's a giant sucking sound that comes out of my bank account, and that's called payroll. And we have to make allocations when it's time to do payroll so that we make sure that that's covered. So in my practice, we actually make 4 allocations a month. So about once a week, we move money from income into the 4 additional accounts, and then we pay our bills on the 10th and the 25th of each month. And I get sometimes asked, well, do I have to do it 4 times a month? Not at all. I have one client that does it every single day, makes their transfers. I think that might be a little overkill, but the point is you can make transfers as frequently as you want, but I really encourage you to pay your bills on the 10th and the 25th because that's going to create some clarity about what's happening with the cash flow of your business. But you look at your own practice and kind of see where that needs to go. But at least try to do on the 10th and the 25th, pay those bills and make those allocation transfers. So here it is, all 7 accounts. We have income from now on. All income comes into the income account. Those are linked to profit, owner's comp, tax, and OPEX. Our profit is then linked to our profit hold account in bank number 2. Our tax account is linked to tax hold in bank number 2. And we've met all the criteria. We're now operating on small plates. We're serving sequentially. We're removing temptation, and we're creating a rhythm. And so here's what the whole picture looks like with the 7 accounts. And I know it looks overwhelming, and one of the questions might be, isn't this a big hassle with reconciliation? It really isn't, because the only account that you're actually paying bills out of is your operating expense account. The rest of these accounts, simply transfers are occurring. We use QuickBooks, and we've got it set up so that the QuickBooks transactions from my bank account automatically occur in QuickBooks, so reconciliation is absolutely a piece of cake and not nearly as complicated as you might imagine. Now, for the 10% of you that I've lost, that you're thinking this is just too complicated, here's what I encourage you to do. If you do nothing else, I want you to open 1 additional account, and from now on until the end of time, I want you to transfer 1% of your income into your profit account. You know, most of us over the course of our career will generate millions and millions of dollars in revenue for our businesses. And if we are able to live on 99 cents of every dollar and put that 1% away, you will be surprised how much money will be set aside. In fact, I would even venture to say for most of us, it will probably be, by the time we invest that, millions and millions of dollars over time. So if you do nothing else and get nothing else from this, just open 1 account and transfer 1%. When you do that, what often happens is the light bulb goes off and you say, oh, I get it. I can live on less. I can live on 99% of what's coming into my practice. And then the rest just opens up for you, and you'll find that you're much more open to doing this. Okay, so what do we do with this quarterly money? So we've got these profit hold and tax hold accounts in bank number 2. Well, we pay our quarterly taxes out of the tax hold account, so that goes to Uncle Sam. Our profit hold account, if you have no debt and you've got your core capital reserves or your emergency fund met, we recommend that you take 50% of that and pay yourself. That's a return on investment. Go have a great vacation, do what you want with it, buy some technology. That's your money to reinvest back into your business or pull out of your business. If you have business debt, I encourage you to get very diligent about destroying your debt. And what I recommend to my coaching clients is that we take 95% of the profit hold money at the end of each quarter, and we throw that lump sum toward our debt. Take the 5% and do what you want with it. Leave it in your profit account. Take it out and go to Applebee's and have a fancy dinner. I don't care what you do. But the point is, let's get out of debt. Debt is strangling our practices, and we've got to get that piece of it under control. And this is a perfect mechanism to have the extra funds that you can really accelerate and start to destroy the debt within our practices. And I love the Dave Ramsey debt snowball strategy. And if you're not familiar with that, what we do is we line up all of our business debt, lowest balance to highest. We don't care about interest rates. And we start attacking, we make minimum payments on all the debts, and we start attacking debt number 1. Once debt number 1 is done, we take what we were applying in debt number 2 and we add it to from debt 1 and we apply it to debt 2. Once debt 2 is done, we take what we were applying to 1 and 2 and we apply it to 3. And I will tell you guys, you will be out of debt before you know it. I work with practices that have hundreds of thousands of dollars worth of debt. And most of us, if we can get on a very disciplined structure, within 24 months can be completely debt-free in your practice. And that can be an absolute game changer in your practice. The last thing I'll touch on as we wrap this up is, well, how in the world, if I'm squeezing my expenses, how in the world am I going to do that? Because I know that everybody thinks you run a really lean practice. And the way we do that is once a quarter, we pull out our profit and loss statement. and we challenge every single expense in our practice. And I do this with my leadership team. I have 3 managers in my practice that help me with this. If you have a smaller staff, you can do it with your entire team, but you need their help and their input in helping you understand what's a necessary expense in your practice. Everything that directly results in profitability in the practice, we put a P by it and we leave it alone. Everything that can be replaced or renegotiated, we put an R by it. Everything that is unnecessary for profitability, we put a U by it. Everything with a U, we fire it. We completely get rid of it. It's not necessary to profitability. You will be surprised at all the things that are unnecessary in your practice to profitability. The things that have an R by it, contact your vendor and tell them, listen, we are trying to run a lean business here. I need the best price you can possibly give me, or we're going to have to consider going to your competition. We really need you to work with us. If we can't renegotiate a better price, we may have to end up replacing you. And it's a difficult conversation to have, but it's very important to get our practices lean. Anything with a P by it, we absolutely leave it alone because it's directly driving profitability in our business. That would be things like our people. We don't want to sacrifice our people. The products that we sell, as long as they are generating profit in the business, those are things we want to leave alone. All the rest of it, we want to absolutely attack. Now, there's something called loss aversion, and human nature is to not give up something we are given, even if it's irrational to hold on to it. And I will guarantee you, as you go through this exercise of getting rid of expenses, you are going to find every excuse in the world not to get rid of an expense. And there's a lot of psychology behind that. And there could be all kinds of layers of emotion. For instance, maybe your friend is the vendor that sold you the product. Or maybe you don't want to feel dumb or that you made a bad decision. Or maybe it's driven by fear that, well, what happens if I give up this expense? I'll need it in my practice. I've never seen a vendor not take you back if you decide that you made a bad decision. So if you get rid of a vendor or some expense in your business and you realize that that was in fact very important to driving profitability, just contact them and add that back in. But the point is, I want you to be very aware that human nature is going to cause you that sense and that feeling of, oh, I don't want to give up that expense because I might need it. If in doubt, just cut it out and get absolutely rid of it. So that's called loss aversion. So as we wrap this up, profitable conclusions with the profit first system are: profit is a choice. We can choose to be profitable. This is a proven system. I'm a certified profit first professional. That means I've been certified to teach this program. I work with hundreds and hundreds of business coaches and CPAs that teach this system to their clients all over the country and really all over the world. This is not just a wild idea. There's lots and lots of structure, lots of examples of this structured plan really working. You know, and most of us don't have a structured plan, and what this will do is really meet that need to make sure that we have that structure in place. This caters to our natural tendencies. It allows us to do some bank balance accounting, and it gives us a much truer picture of what's happening within our businesses, because our businesses can no longer survive off of leftovers. We're starving our businesses of the needed cash flow to make sure that it runs profitably. And then finally, you know, a lot of us on this call took a huge risk to be our own business owners, and we really went out on a limb to make our businesses something more than just becoming an employee of something, and we deserve to be rewarded for taking that risk. And so this is a way that we can increase the reward that you deserve back to yourself. So those are the profitable conclusions. So what are some goals that we can do? Well, what this does is this creates a plan for us. It gives us the framework and the structure that now we can start to work off of some sort of a plan that actually has some meat behind it and some experience behind it that we know is going to work. Number two, it bakes profitability in the practice. So no matter what happens outside of our businesses, no matter what happens with the economy or with politics or who's in office, we are guaranteeing and assuring that profitability always occurs because we're always taking our profit first. And then finally, it helps us by allowing us to manage our practices based on what are called key performance indicators, or KPIs, or sometimes called metrics. And that's where systems like the Edge can really come in and help us understand, are we meeting our profitability goals? And some of those metrics that we track in our business are things like our collections per exam and our complete eyewear exam capture rate. How well is our optical doing in selling products in the practice, because that all drives profitability. What are our average collections per OD hour? And what are our collections per non-OD payroll, which is one of my favorite, and we call that the labor efficiency ratio, which says for every $1 I invest in human resources, what kind of return can I expect to get in my practice? And those are some of the things that the Edge can really help us with. And I want to turn this back over to Yvonne and let her just give us a little bit more guidance on some of these metrics that we can track.
Well, as luck would have it, my internet has just gone down. I don't know what's happened. Everything just flashed off. So.
All right. Well, I can either take back the screen and, or you want to give it a minute?
Yep. Yep. Give me a minute, and then I will see if I can't connect back here in just a second. That would be great. Can you hear me?
Gotcha.
Okay.
So Nick, while Yvonne is kind of rebooting her stuff, we had a couple of questions come in. If you wouldn't mind, we had one was, do you have a benchmark for cost of goods? You know, I know that directly drives our profit, but it kind of is, if you're thinking about lenses or frames, I think that's what we're saying, or contact lenses. Do you have a benchmark in that area?
Absolutely. So one of the things that I've gotten pretty good at is looking at a practice and trying to figure out where the leaks in the bucket are occurring. And the very first one is our cost of goods sold. So those include our frames, our lenses, contact lenses, and maybe if you sell some optical supplies, that sort of thing. And we pay a price to have those products that we then resell. And the profit margin that we generate from selling those products is a very, very important part of the financial health of our business, and that's called our gross profit. So we have income that comes in. Once we subtract our cost of goods sold, that gross profit number needs to be at a high enough level to make sure that all of the operating expenses that fall below that are then met to ensure the profitability of our business. The typical cost of goods percent as a percent of revenue of the business on a national average is somewhere around 28%. That data comes from the old MBA data, as well as some of the internal data that I've looked at from some of the larger practices. But one thing I want to really stress about that is that number is really dependent on the mix of your business. For example, if you're a high optical business, meaning your glasses store sells a lot of products, your cost of goods will be higher versus a medically oriented practice where the retail portion of your practice represents a smaller portion of the income in your business. So don't get too wrapped up in how your costs of goods compare with the industry, so much as comparing your cost of goods with yourself over time, always understanding that, of course, we want to squeeze that bucket of expenses as much as we can, because we need the gross profit number to be as high as it can, which will leave more to meet our operating expense needs.
Thank you very much. And I've got one more while we're here. This is, how do I decide to purchase a new fundus camera or OCT? Should I pay cash for it? Should I wait, save enough money to pay for it? Spread the love? How should I do this?
It's one of my favorite questions. So I think when I'm thinking about bringing technology into my practice, it has to meet 3 criteria. Those 3 criteria are this. Number 1, does it improve my cash flow? In other words, is the revenue that's going to be generated off of that new piece of technology going to exceed my outlay to bring that technology in, especially if I'm going to finance that technology? It's got to improve my cash flow. Number 2 is it's got to improve efficiency. will it make me more efficient? And that doesn't mean am I going to be able to do a faster eye exam, but it might mean that I can get to my diagnosis more efficiently or more quickly. So it's got to be more efficient. Number three, is it good for the patient? And that's the real simple one to meet, because all this great technology out there is all really good for the patient. The problem is we often buy technology strictly because it's good for the patient. We don't consider the efficiency piece of it, which in fact sometimes slows us down and makes the exam process even longer. Or we get upside down on the cash flow because we thought it was going to generate revenue and we overestimated, because the sales guy said, oh, you can do 20 OCTs a month and it'll meet your monthly obligation on the OCT. Well, what happens if we only do 10? Now you're upside down and you've actually got negative cash flow. So it's got to meet those three criteria. If it meets two of the three, I still consider it, but I certainly back off on my decision. And then, do I pay cash versus finance? I'm a big believer in paying cash whenever you can, because when we can leverage with cash, we can get better prices, and the return on investment on a cash investment is almost always better than financing that technology. There are some exceptions for especially new practices, things like wide field digital fundus photography, partnered with OCT technology, and selling that as a bundled diagnostic suite of tests is an amazing way to generate extra revenue in the practice. So that might be an exception. But when at all possible, pay cash. And if it doesn't work out and you made a mistake, you can liquidate the asset and you're not strapped by this burden of additional debt. So Yvonne, I see you harness the internet again.
Yes, imagine. All of a sudden it just went completely down. So Dr. Kling, one of the things that you talked about was, setting goals, and that there were, definitely 3 or 4 key metrics that you really think are most important that we need to really keep our eye on the ball, so to speak. And so one of the things that I love, so if this is my practice here, and, you talked about collections per exam and complete pairs capture rate. So can you give a little bit more insight on why these two in particular are most important? And then I do want to show an area as well, because I do track OD hours as a whole as well as individually. And so I want to kind of wrap up with, why that is an important piece to track as well.
Absolutely. So the sort of the granddaddy of them all, the granddaddy metric that I think is so telling of a practice is this collections per exam metric. And basically this says, it takes your entire collections for your practice over a given amount of time divided by the number of comprehensive exams that we perform, and we get an average number of average revenue dollar per exam. Now, I encourage everybody, don't get stuck in the weeds of how we're defining a complete exam. Just pick away and do it consistently, because again, we don't want to get too wrapped up in comparing ourselves to others, but more about comparing ourselves to ourselves. But this metric is the telltale metric of how well we're doing at driving revenue in the practice. And one of the interesting things about this metric is that we found that there is a sweet spot for this number. And what I mean by that is, if we are not busy enough and we're not selling enough product, that number starts to decline. But on the other hand, if we get too busy, that number starts to decline as well, because now we're rushing and the doctors are not making recommendations in the exam room. We're not discussing second pairs. We're not possibly getting them to our retail space to have that conversation with the optician. And so you have to find the sweet spot in your practice where you're maximally producing revenue for every eye exam that you perform in the practice. So for me, like I said, that's kind of the granddaddy of all metrics that we look at. The second one was the complete eyewear sales per exam. For most of us, our retail business generates, upwards of 50% or sometimes more of the total revenue in our practices. And so having our glasses store generate a lot of revenue is extremely important. And that's a very good metric for us to keep our finger on the pulse of how well is our retail business doing. How well are we selling frames, and how well are we selling lenses and lens add-ons? How well are we doing at second pair sales? Because that's a cumulative number that gives us some sense of, for every eye exam that comes in, what percentage of those folks are going out and buying a complete pair of glasses. And you can dig deeper into that and get granular. We also look at frame capture rates, which is number of frames sold per exam, and lens pairs sold. But that complete pair of glasses per exam is a fantastic metric to look at. And then the last one, Yvonne, that you mentioned was the collections per OD hour. And as I mentioned, we have 4 doctors in the practice. And what this metric tells us is that for every hour that a doctor spends seeing patients, how much revenue are they generating for the practice? And one of the very valuable things for us in our practice is the fact that we do have multiple doctors, and it gives us a tool to compare doctor to doctor to see how they're doing in the exam room of selling products. And what's really interesting is that when all other variables are the same opticians, same technicians, we find a difference in the productivity of the doctor. And so what that does is allows us to go back and look at the doctors that might not be producing as much and say, hey, let's talk about how is it that your collections per OD hour is a little bit lower? Are you having conversations about premium progressives? Are you talking about lens coatings? Are you getting into second pair recommendations and sunglasses? So that metric really serves us well to help us compare doctor to doctor. If you're a single doctor practice, it's a great metric to compare yourself against yourself. And then also you can use the industry averages and your colleagues to see where you compare of similarly sized practices. So I love that collections per OD hour is a fantastic metric to get a sense on how well we're doing as selling products in the exam room.
I'll tell you, I never really considered collections per OD per hour, but I think this is definitely important. We spend a lot of time on, capture rate and, working with optical teams and things like that. And I think this is an important area that perhaps maybe gets overlooked just a little bit.
Absolutely.
I have one other question. So this goes back to the tax thing, but I think what I'll do is I'll hold this one until the very end and just kind of allow you to kind of wrap up with your exciting tools that you have.
Okay, absolutely. Well, listen, again, thank you, Vaughn, and everybody for attending. I wanted to leave you guys with an opportunity to get a couple of tools in and around related to Profit First. If you will text the word GPN 2019, GPN 2019, to the number that you see on your screen, what will happen is you'll get a response back that asks to enter your email address. When you enter your email address, we will send you 3 tools around Profit First that I think will be helpful for you. One will be the first 2 chapters of the book, so you can get a sense of sort of the flavor of the book. It's a very easy read. I encourage everybody to pick up the book Profit First by Mike Michalowicz. Number 2, we'll give you some lists of some Profit First friendly banks. There are some banks that really embrace this more than others, and so I'll give you that tool as well. And also I'll give you some FAQs, just a sheet that says, here's some frequently asked questions, and that'll be a valuable tool. I promise you I will not abuse the information. This goes to Heather, my administrative assistant, who will get those out to you within a few days. So anybody interested in that, please take advantage of that. I'd love to get those tools out to you.
That's awesome. Thank you so much, Dr. Kling. I think you have something else that you wanted to share as well.
Yes, and thank you for allowing me to pitch this, Yvonne. So one of the things that I've been doing in my practice this last year is holding workshops in my practice, and this is a opportunity where doctors can come in and sit and spend the day with me, and we usually limit it to 7 or 8 doctors in my conference room, and we have you bring your actual financials, and we spend the entire day building a system around your practice. And I wanted to just release the dates for 2020. They're February 7th, June 12th, and October 9th. If you go to the profitablodoctor.com, there's some more information there about the upcoming workshops. There are some details that we've yet to get on the website, but it will give you some idea of at least the dates. I wanted to get that out to you. Very limited space. They almost always sell out. So if that's just something that you're interested in, I wanted to make sure I shared that with you.
That's so wonderful. So thank you so much for that. I know that, being able to provide some of the best resources out there that help doctors or other eye care professionals, take their practice to the next level is, definitely important. And understanding, things that can impact us like expenses and taxes and those sorts of things where we kind of put those on the back burner and think about those last. So I think this is so incredibly important. I know that we have one other additional question, Dr. Kling, and then just for anybody else, so again, thank you so much for being part of our webinar series. If there's any additional questions that you have for Dr. Kling, please, here's his email is on the screen as well as his cell phone number. And I'll wrap with this one question for you. The question is, why is it that we put things into the tax hold bucket versus rather straight into the tax hold?
Great question. So if you think about how long it takes money to move from the income account to the tax account, that occurs instantaneously, literally within seconds. If we were to move money from the income account directly into bank number 2, there's a 2 or 3 day lag that occurs, and that makes so that money will sit in the income account for a couple of days, and that could complicate or confuse or confound the number that's in the income account, because our goal is to move that money out of income immediately. Because what happens is when we make our transfers and money goes into profit and then into profit hold, we'll have no money in income, no money in profit. When we pay ourselves out of the owner's comp account and then that goes into our personal account, that owner's comp account goes to zero. When we move the money from tax into tax hold, that account goes to zero. And then when we pay our bills out of operating expense account, that generally goes to zero. Then we pick up our phone and we see a bunch of zeros. And that is the true picture of your business. So the goal is to get the money out of the accounts as quickly as we can and not let it sit in, for instance, in this example, in that income account for 2 or 3 days until it's allowed to transfer. But great question.
Awesome. Great. And I lied. One more question, only because it's been asked a couple of times. How long, so like once we do all of these sorts of things, how long does it take to implement this process?
So there's a little work involved. I'm not going to sugarcoat that. There's a little work involved because you've got to get your main operating account. You've got to turn off any auto deductions. If you got vendors that are pulling money out of your account at random, I would recommend that you stop that immediately. Take back control of your account. Only you should be able to move money or take money out of your account. That takes a little time to unwind. Getting the bank account set up takes a little bit of time to get set up. Once you get on the rhythm of starting and get those accounts set up, it usually takes about 2 or 3 months for this to start to become real automated, because the first couple months, what you're going to realize is that you're living beyond your means. A lot of us are using tomorrow's income to pay yesterday's bills, and that's going to become very obvious in the first couple of months of this program, and we've got to break that cycle, and that's painful. It takes us a while to get through that, but as long as you push on and get through that, just give yourself a break. There are no hard and fast rules. You can be flexible with the system, but 2 to 3 months is what you should give yourself to make sure that you get this thing set up properly.
Awesome. Thank you so much, Dr. Kling. And I really appreciate you kicking off our year-end webinar series. And for those of you that are still out there, again, Dr. Kling's information is up on the screen. Please reach out to him for any additional questions that you might have. And for the rest of you, we'll see you back next week, Tuesday, November the 5th, for our second series of 6. Take care, everybody.
Thank you.
Thank you.